So this webinar is obviously intended for informational purposes only. Doesn't constitute as financial advice. Always consult a qualified advisor before applying for a mortgage. We have plenty of those here at L&C, so please don't go anywhere. Back to you, Joe.
Right, let's get started. So first and foremost, let's introduce you to our star-studded panel. First off, we have my co-host, Siobhan, who has recently joined L&C around about 6 months ago. Siobhan comes from a financial services background, working amongst mortgage brokers for the last 7 years. We've got Dave Hollingworth, who, a regular on Sky News, who has kindly given up his time to join us on the webinar today. Dave's been working at L&C for over 25 years. His opinion on the market is regularly sought out by the national and trade press. We've got Ismail with us, a mortgage advisor here at L&C, supporting customers for over 1.5 years, including helping first-time buyers like yourselves get onto the property ladder. And of course, we have our special guest joining us from Generation Home, Paddy Doyle. He'll be giving a lender's perspective on the market and schemes that can support first-time buyers. Welcome along, Paddy. Thanks for joining us. And then also we've got myself. Less said about that, the better. I hope that gives you more of an insight into us. So, Siobhan, I think we're ready to get going.
Thanks, Joe. Don't put yourself down like that. You're just as important. So now, obviously, everyone's fully introduced to our star-studded lineup. Let's get started. So before we do a deep dive into all things first-time buyer related, I'm just going to hand over to Dave, who's going to give you a little bit of an overview of who L&C are, if you don't already know, with some key stats about us. So without further ado, over to you, Dave.
Thanks, Siobhan. Hi, everyone. Good to be here. I'm just going to give you a quick, brief overview of who L&C are. So we're UK's largest fee-free mortgage advisor, or broker, as they're often referred to. And a broker is basically there to sift out the best deal for your individual circumstances. So what we're trying to do is look right across the market, look at what all the lenders are offering, and that will typically amount to thousands and thousands of different deals. But then pinpoint not only the right rate, but also the right kind of criteria. So it's going to work for the individual customer, and we can come up with the right recommendation. Really excited this week that we've actually tipped through a really huge milestone for us. So very recently just submitted our millionth mortgage application. So that gives you a sense of how long we've been going and how many customers we've helped through that 25-year plus years that we've been established. We don't charge a fee. I'll just explain what fee-free when I talk about fee-free, because actually, obviously, we're not doing this for nothing. We do get, all brokers get paid by lenders for introducing business. It's just that we're not charging an additional broker fee on top of that. So lenders will pay mortgage advisors a payment, a procuration fee as it's called, for introducing business. We're just not charging any other additional broker fee on top of that. We have been going for over 25 years. We've got 200 plus awards. That's something that we're really proud of. And we make up there's about 800 people who make up L&C. So that will not just be advisors. That will be split across the advisor, who will be your initial port of call, who will be coming up with your mortgage recommendation, but also the case managers, who will then look after the case as it's going through to getting mortgage offer, and then hopefully taking you through to mortgage completion. And hopefully that just gives you a rough idea. We're dealing with something like 100 lenders at the moment. So that really is spreading right across the market, from the biggest high street lenders through to those who can help with more specialist inquiries. But yeah, ultimately, we're a mortgage advisor that's looking to get you the right deal from across the market for your individual circumstance.
Thanks very much, Dave. So now hopefully you all understand a little bit more about who we are at L&C. I think we're about ready to start talking through everything first-time buyer related. So with base rate changes and the upcoming budget, many of you may be hesitant to take your next step. Dave's going to give us a bit of an overview of the current market, which will help provide hopefully some more insight when it comes to looking to purchase your first home. So back to you, Dave.
Thanks, Joe. Look, I thought I'd start with the perhaps a really obvious thing, but house prices are right at the heart of the issues that first-time buyers face. So these two charts give you a different take on house prices. These are both from Nationwide's house price index. Just on that note, you'll see lots of different house price indices. They'll all be reporting slightly different figures. Nationwide, for example, is basing it on its own mortgage data. But then you've got others like Rightmove, which will be looking at asking prices, and then the actual figures that have gone through. So those might be a little bit delayed because they represent deals that were agreed a few months prior, but actually give you a kind of idea of what those done deals look like. But Nationwide's give you a good overview, and for these purposes, I think these two charts sort of sum up the issues that first-time buyers are often facing. So that blue line graph, that's the annual rate of change in UK house prices. Now, it's been a kind of topsy-turvy period over the last few years, very turbulent. You can see there where we started August 22, that the rate of house price change was really high, double digits, hitting 10% there. House prices had rocketed really post-pandemic. Everyone was rushing to move, almost counterintuitively at the time. But the race for space, as it was called at the time, saw people looking eager to move. Interest rates were still really low. And of course, that pushed prices higher. But you can see how August 22 was just before the Liz Truss mini budget. But already interest rates were on the way up and high inflation was causing concerns in the market. That pushed mortgage rates up really rapidly. And actually, you can see how that started to hit confidence. So we've gone right there down to negative annual rate of change. But that's bounced back. So actually, house prices have been remarkably resilient. And the chart on the right, the average UK house price, just shows you that picture over a much longer run. That's about 10 years of data there. But you can see where it peaked before dropping back quite sharply. But since then, it's really kind of leveled out and even started to rise again. So, you know, the difficulties for first-time buyers, which stem from high prices, have just not gone away. If we can move on to the next one. I mean, that underpins really the two main problems that first-time buyers are likely to face. So firstly, it means that you need a bigger deposit because you're saving towards a bigger house price, bigger purchase price. And secondly, you need bigger mortgages. Now, these sound like really obvious things and they're relatively simple to understand, but are massively complicated to get around for first-time buyers. If we move on to the next one. So you get this affordability squeeze. So by the sheer fact that you need to be able to borrow more, it really makes it hard to meet the lender criteria. Lenders will look at affordability not just from an income perspective, but they'll also be looking at what other commitments you have. So they're not looking to just apply a straightforward income multiple. They'll be looking at more widely at income, but also what kind of commitments have you got? That could be other loan commitments. It could be your existing outgoings, and is looking to make a more individualized assessment of what is affordable for the borrower. Having said that, we always tend to trickle back to what kind of income multiple can you get. Probably I would have been saying typically 4.5 times. What we are starting to see is a bit more flex in the market, and I'm sure Paddy will give his take on this, but there's been a few shifts in the way that lenders are able to approach affordability. So rather than when applying stress rates, that's to say they're looking at the fact that you can afford the mortgage right now, but also in the future. They're considering what might happen to interest rates. What if interest rates were higher? Does it still look affordable? And there's been a little bit of movement there, which has enabled lenders to be a bit more forgiving. And a lot of lenders have moved really quickly once the regulator has given that kind of clarification around how they can approach stress rates to give a bit more flexibility. So that is helping to ease things a little bit, but that standard affordability test is still there. Now on the right, you can see just how that kind of manifests itself in terms of the challenge for first-time buyers. And if you look at that graph, that's telling you the grey bars are the long run average. The red bars are reflecting where we are in the latest data, which was second quarter of this year. Now, nearly every region is seeing a higher percentage of pay being taken up by mortgage payment. That will, of course, be exacerbated by the fact that interest rates have risen. They were so low for so long that many were hit hard by that. Even though they've been dropping back, you can see just how that is starting to impact and doesn't make life any easier for first-time buyers. On the upside, base rate has been coming down and mortgage rates have been falling as well to reflect that. So fixed rates, which will often be something that first-time buyers will focus on, they have been easing back on the upside. So the second part of that, and I don't want to get too much into that chart on the left, but what this does show, these are figures from UK Finance, and what they do is just highlight the size of the issue around deposits. So with high and resilient house prices, that means that you're going to need a bigger deposit. Now there's a good range of deals out there where 5% deposit is required. So although that's been up and down over the years, actually we've got really good availability of 95% mortgages. But nonetheless, when you're facing really tough house prices environment, that does start to feed through in very, very significant deposits. Now, these are split down by those who are assisted and those who are unassisted. You can see on the right that unassisted first-time buyers still make up the lion's share, but such a huge chunk are seeking help, probably from Bank of Mum and Dad. And that's because it's just impossible to buy without it. And when you look at the kind of numbers that are roughing out for the UK on average, you know, average deposits of 60,000 just helps to highlight how big that problem is. And often these two things are completely interchangeable. The affordability issue and deposit very much hinge on the same thing. If you're capped at a certain level of borrowing, but purchase prices are so much higher, then of course it does mean that you've got to push that bit higher. There are deals that are coming to market now where smaller deposits are a possibility, or even no deposit potentially. But that, of course, depends very much on whether you can meet the affordability requirements to borrow the entire purchase price. Having said that, I think the market's moving positively and there's a real sense of momentum in trying to take on some of these challenges and make the options for first-time buyers that little bit easier.
Thanks, Dave. That was really helpful. And I guess there's probably quite a few first-time buyers on the call who feel a little bit hesitant to take their first step because of the current uncertainty. What would your advice be on this?
Yeah, I think it's really easy to get stuck on whether it's the right time to buy, and it's often, you know, is now a good time to buy. I think really, I always say it kind of boils down to what's going to suit you. If you found a property that is in the right kind of ballpark it's affordable, it's going to suit your requirements, and not just for the short term, but potentially over the medium term, then for me, it feels like that is the right time to buy. Now, what you can't do is second guess what's going to happen. We've seen that. I mentioned the mini budget earlier. No one would have seen that coming. The impact on mortgage rates was huge, and we went into an extremely volatile period, more turbulent than at any point in my career, at least. So to try and second guess that would be almost impossible. And that's why I think first-time buyers would be very much focused on what they can get as a fixed rate. So at least they then can build in some certainty around what the mortgage payment might look like, whether that be over the shorter through to medium term. So you can give yourself a little bit of peace of mind by looking at fixed rates to do that. What will happen with house prices really hard to gauge. So for those with small deposits, it is a consideration, but that's why they might want to like build in a bit more security in their mortgage payment, just so that if there are ups and downs in house prices, they can ride out those ups and downs rather than be faced with negative equity and a need to sell if the mortgage starts to look less affordable. So there are ways that you can help yourself gauge some more certainty.
Brilliant. No, thank you. That's really, really useful to know, and I hope that's helped some of our attendees on the call. So without further ado, I think we're back to you, Joe.
Great. So hopefully now you understand a little bit better what's happening in the current market. Now we're going to hand over to our special guest, Paddy, from Generation Home, who's going to provide you with a little bit more info on the market, along with some schemes to help get you on the property ladder. Over to you, Paddy.
Thanks, Joe, and thank you to the rest of the panel, and good evening to everybody joining. Thank you for making the effort this time on a Tuesday evening. So my name's Paddy. I'm a sales lead at Gen H, or Generation Home as we're also known. We're a residential lender that are really here to help first-time buyers. They're really at the heart of what we do, but we also help those that are looking to move and remortgage as well. We were sort of born out of a small bit of frustration by our founders who had difficulty buying their first home and needed some innovation in the market in order to help them achieve that. And that's really what's carried us through the first 5 years of us lending and helping first-time buyers. So what I'll hopefully aim to do over the next few minutes is give you a little bit of market update and a few figures, and then I'll talk through a few sort of schemes that we and a few other lenders are able to support out there to enable more first-time buyers onto the property market. And I think it's probably important to note at this point that not all schemes are applicable to everybody, and it's really important to help. It's really important to use a mortgage advisor to help navigate you through what is a fairly complex market, particularly when we look at some of the sort of specialties that some of the first-time buyers are doing, because it's not a one scheme fits all approach, as will become a little bit more apparent as we move through the slides. So if we move on to the next slide, really just sort of backing up what Dave's already mentioned, affordability is a real challenge for a lot of first-time buyers. We've sort of seen here, so this is from the UK Office of National Statistics. The average house price in the UK is now 8 times the average salary. You only have to go back about 30 years or so for it to be half of that, or close to 4.5 times. So that's become a little bit more of a challenge. And then, as has already been highlighted as well, there does have sort of regional discrepancy. So in London, we've actually seen it be closer to 11 times somebody's average salary, or the average salary compared to house prices. So so those sort of represent the challenges from an affordability perspective that first-time buyers do come across. And the reason for that, in some instances, is purely down to it's purely down to supply and demand and number of properties being built in certain locations versus population increase in certain locations. So I won't pick the bones out of this particular graph, but as you can see here, City of London has got quite a large population growth, and has also seen the highest increase in prices compared to salaries and incomes, meaning that it is a little bit more difficult for that to happen. And the reason why we as a lender and others as well are so keen to help sort of solve this problem, if we move on, is because we recognize that actually getting into your first home can mark the start of a few other milestones. So it then sort of enables you to start having a family, think about having pets, getting married, and sort of setting yourself up for the future as well. So by delaying buying your first home due to challenges in the market, it can also have a knock-on effect for the other sort of generational milestones that people like to achieve as well. So we sort of see it as a really important point to get people into homes. A few other figures for you show that actually earlier in the 2000s, the average age of the first-time buyer was 29. It's now 34. Again, there's some regional discrepancies here. This is average for the UK. I looked at some other statistics earlier in the week where Wales was 31, but London was 38, for example. So, so the age of first-time buyers in general is increasing as the years progress. And the other thing that's increasing, which Dave has already touched on, is the size of deposits as well. So again, a bit more of a discrepancy around the country, but this just highlights the average deposit size sort of across the UK, which can feel quite daunting, I think. But there are lots of other options out there to help with deposits and affordability, which I will aim to highlight a few of these sort of current schemes and sort of current options available with us and other lenders that the advisors at London and Country have got access to. So a few of the highlights, I suppose, Dave's already mentioned having sort of an average income multiple of 4.5 times, which is fairly commonplace. We've seen some recent relaxation in regulation that enables lenders to do more higher income multiple lending. There are some lenders out there that will now do 5.5, 6, even 7 times income multiples, which is nice and certainly helps people onto the property ladder. Deposit size is also reducing. So 95% loan to value mortgages, or mortgages with just a 5% deposit, are now more readily available. And the government has actually backed the 5% deposit scheme even further more recently as well, which gives lenders a bit more confidence that we can actually lend money at this sort of rate as well, which is nice. And even we're seeing less than 5% deposit mortgages becoming available, with some saying that zero deposit is now plausible, which is really exciting and will certainly help people that are locked out of housing markets onto the property ladder. There's some other work that's being done by lenders to introduce what is called joint borrower sole proprietor mortgages, where you can utilize sort of family income to help you borrow more, and also developers are playing their part as well to help people borrow a little bit more and also help with the deposits as well. So I'll run through a few of these in more detail. So the higher income multiples are becoming a little bit more commonplace. So as I said, there was some regulation that was relaxed only a couple of months ago that enables lenders to lend more higher income multiples. Now, the things to sort of bear in mind with this are, obviously, if you are borrowing more, it will have an impact on how much you are repaying each month. So that's something that's really good to sort of discuss with your advisor. And some of these lenders do become specialists, so the interest rate can be a little bit more than what is usually available for somebody that's borrowing less on their income multiples, for example. Some of these do often come with minimum income requirements for either an applicant or a household. So you can see quite quickly that that this won't be applicable to everybody as a first-time buyer, but it certainly opens the doors for some. For those that don't quite have the minimum income options, if we move on, Joe, there are other options out there available to help people that are struggling with actually being able to borrow enough to buy a property in their area or buy the property that they like in their area. So something that we do at Gen H and lots of other lenders do as well is something that's called joint borrower sole proprietor mortgages. And that's effectively when people are utilising their community, most commonly their family or friends in some scenarios, where they can go on the mortgage and actually utilise their income to help them borrow a little bit more, because lenders are comfortable knowing that they've got access to additional income should they need it, in an attempt to help people borrow more to buy the house that they want. There's no impact on stamp duty implication for the joint borrower or income boosters, however you want to term it. But again, sort of keep an eye on your monthly payments if you are borrowing a little bit more, and your advisor will be able to guide you through what that looks like for you as well, should that be an option available to you as well. The other point of sort of product innovation from a lender perspective that is becoming a little bit more popular, and was certainly popular earlier in the 2000s, is interest only and part mortgages. So this is something that we've launched recently, and a few other lenders have sort of committed to doing sort of more interest only lending, and that's where we've sort of recognized that by borrowing more, it can cause a little bit of anxiety in terms of monthly payments, but by putting things on interest only or part and part, it can help you reduce your monthly outgoings, but you won't be making the sort of payments towards the capital as you would with a normal repayment mortgage. So you will have to be conscious about how you're going to repay that in the future. So we see this as a really good tool to actually enable people to borrow a little bit more, but enable them to borrow a little bit more and keep their monthly payments low. But there is that sort of mindful piece about how it's going to be repaid in the future. And that's something that your advisor can sort of guide you through as well, which is nice. And as I touched on earlier on, developers are engaging in this sort of conversation around enabling more and more people onto the housing market. So new builds are becoming more available, where developers are offering incentives, often up to 5%, which is okay with us lenders, towards your deposit, meaning that you can buy a new build home with just a 5% deposit, and the builder giving you 5%, so you only need to borrow 90% of the value rather than 95%, for example. Other lenders are getting even more creative, where some lenders are reintroducing what was formerly known as the government help to buy scheme, in a very similar format, where equity loans are available, particularly on new builds, to enable people to buy the new build house that they want without having to borrow 90%. Some will say you can only borrow, you'll be able to borrow 80% on the mortgage and then have a small equity loan available in order to sort of top that up if you can't borrow the rest, for example. So that's really good conversation and innovation between lenders and developers in order to make new build homes more accessible as well, which is nice. And then, as we've already touched on, the low and no deposit options for home ownership are now becoming a little bit more accessible from some particularly specialist lenders, who I won't name, but they are available. There are now 3 lenders out there that will do a 100% loan to value mortgage. Last time I checked, I'm happy to be corrected if anyone knows of anything different on the panel. But again, a lot of these come with minimum income requirements. Some need a track record of what your current living arrangements are in terms of making sure that you paid your rent, for example. And the things to bear in mind with this as well is very often the length of fixed term on the mortgage is often longer to reduce the risk of negative equity if there was a small dip in house prices as well. So that's something to be mindful of, and certainly that sort of risk appetite is something that you should be chatting about with your advisor, so they can help you through that sort of environment and help you make the right choice for yourself. Great stuff.
Thanks, Paddy. There's some really, really good nuggets there, and it's always good to hear a lender's perspective on things, especially when it comes to obviously first-time buyers. Would you say lenders are actively looking for more ways now to support first-time buyers getting onto the property ladder, like given the number of schemes that are available and new schemes that are becoming available as well?
Yeah, absolutely. I think when I speak for us at Gen H, it is really the bedrock of what we do in terms of helping people onto the housing ladder. But we also recognise and work with a lot of building societies and other sort of banks that are having their own sort of innovative schemes that do allow them to do things like higher income multiple lending or lending with lower deposits to really help first-time buyers solve the challenges of buying a house and having to either borrow more or put down more of a deposit as well, which are probably the two biggest barriers to entry for first-time buyers. So there's lots of innovation out there for lenders, and it's just a case of helping first-time buyers in that respect. So yeah, absolutely.
Brilliant, brilliant. Thank you. That was super, super useful, and I hope everyone else found it useful as well. Please keep your questions coming in, guys. We'll answer them at the end in the Q&A. So no questions, a silly question. So feel free to put anything down if you want anything answered today by the panel. So now we've covered all things around the current market and schemes available to support first-time buyers. We're going to do a deep dive into the mortgage process and our services with L&C's advisor, Ismail. So without further ado, over to you, Ismail.
Yeah, thanks, Siobhan. Good evening, everyone. My name's Ismail, a mortgage advisor here at L&C. So I'm just going to run through the process with us. So I'll start with stage one. Now, firstly, you want to understand how much you can save towards a deposit. You want to make sure that the property that you are purchasing, is financially feasible. So booking an appointment with L&C means that we can run through your affordability over the phone by looking at income and current commitments, to which we can then produce a decision in principle that you can then use to offer on a property. So let's say, for example, you wanted to purchase a property worth 200,000, and after running the affordability checks, we know that you can borrow, let's say, 180,000. You would then know that the deposit that you would need would be £20,000. Now, you can run this backwards. So let's say if you had a £20,000 deposit, we can then run your affordability, and that would give you an indication of what price points you could be looking at. Now, a few things around this. So running the decision in principle yourself online can give inaccurate numbers. So you may not, know how to calculate your sources of income, as all lenders view income calculations differently. So I would suggest to speak to an advisor about this. As well as that, certain lenders do understand the financial difficulty that besets most first-time buyers, as we've just discussed, and therefore have offered certain products to help them enter the market. Paddy has just mentioned a few there. So on that basis, again, I would recommend speaking to an advisor, as this is something that may not be brought to your attention when doing a generic search yourself. Now, lastly, estate agents will ask for certain details, your decision in principle certificate, solicitor details when placing an offer on a property. So it is useful to have already spoken to a broker first, just so that you have all that to hand. I will discuss conveyancing in more detail in a moment, but just moving on now to stage two. So that is the application stage. So once the offer's been accepted, you'll then come back to the advisor who you've previously spoken with, and we'll run through what is called the fact find. Now, the fact find is essentially a conversation where we ask certain questions to pull all relevant information from you so that we can get you the best mortgage. Now, if you've already completed an application form with us to 100%, most of the information that you would have provided would have already been covered in the initial conversation. So, your personal details, employment details, commitments. However, once the property has been found, we will then ask more specific questions surrounding your property. We'll delve into whether you want maybe an interest only or repayment mortgage, if it's a fixed or a variable, how long you want the overall mortgage term for, and how long you want the initial fixed rate period for as well. Now, I would suggest to have an idea of what you want. Definitely verbalize your thoughts over the phone. We are there to help you make the best decision. As well as that, I would advise you to fill out an application form to 100%. It not only saves time, but it gives you an idea of what conversation would be like, and prompts you to think about what you want from the mortgage product moving forward as well. Now, moving into stage three, so the recommendation stage. So after we've obtained all relevant information from yourself, we will then go away, conduct our research, and then come back to you with a suitable mortgage recommendation. Now, we do this by aligning your circumstances, not only with lending policy, but affordability as well. Now, within this conversation, we'll break down your mortgage payments, your product features, along with any fees that may be associated, so that you feel confident in knowing what financial commitment you're getting yourself into. Now, I would suggest not to be afraid to, Ask any and all questions about the mortgage product, no matter how silly you think that they are. The conversation itself, don't get me wrong, is very thorough. We do break it down in the most colloquial way as possible. However, like I said, any questions surrounding the product, just don't be hesitant to ask. We want you to walk away with confidence in the mortgage product, and we will definitely help you get there. Now, just moving to stage 4, so that would be the underwriting process. So once you're happy to proceed with the mortgage product, we can then go ahead, submit the application, and after the application has been submitted and accepted in principle by the lender, a case manager from our fantastic case management department will be in touch to help you through the underwriting process. Now, their duty is to liaise between yourself and the lender. Now, we also give you access to an online portal to assist you in this process. For example, any queries that the underwriter may have, any documents that they may request from yourself, you'll simply log into the portal where you receive, where you can upload all documents that you need, to get you to the mortgage offer. Now, I would again say that to have all kind of generic documents ready, payslips, bank statements, I will touch on this more shortly. But as well as that, be as proactive as possible during this process to help you achieve the mortgage offer in the quickest time frame. Now, underwriters tend to work on a 24 to 48-hour SLA unless they're under pressure, which in that case, if that was to be, if the market was to put a lot of pressure on these lenders, those SLAs could then increase to anywhere between 3 to 5 working days, maybe even longer. So just moving on to the next slide, I'll just run you through the kind of services that we do provide. Now, we offer protection, so all first-time buyers should consider, taking out some form of protection. Most people don't view it like this, but a mortgage essentially is a large debt. It is a commitment that needs to be paid regardless. Now, our expert advisors can offer, great advice surrounding life insurance, critical illness, income protection, and can also provide you with a recommendation for you to consider as well. Now, if you don't already know this, you will need a conveyancer, which is technically a property solicitor. Now, they will help you complete the purchase. Now, I would advise you to get this part right, as a vast majority of the purchase process does lend itself to conveyancing. So you do want someone who's efficient. Now, at L&C, we offer some fantastic perks using our conveyancers. We offer no completion, no fee, free buyer's protection insurance. We have conveyancers who work directly for L&C within our trusted solicitor firms, along with an in-house conveyancing team for if and when you have any further questions that need answered. So if you're interested, you can discuss this with your advisor during the initial stage, and we can send you a personalized quote. Now, please remember as well, it is policy to have the correct home insurance in place on exchange of contracts. And again, this is something that we can help with, so speak to your advisor about this during the fact find. We also offer surveys. So, because you are purchasing a property, you may want that peace of mind that it's structurally sound with no defects. And in that case, you may want to consider getting a level 1, 2, or 3 RIC survey completed. Now, again, if you chat to an advisor about this, we can advise on the difference between the 3 and help point you in the right direction moving forwards. Now, lastly, the rate check service. Now, this service is imperative to securing the most competitive rate. We understand that the market can be volatile, and therefore we would advise you to lock into the best rate possible as of right now. Now, with this service, it means that we can then monitor the market. If the rates do fall, we're more than happy to switch you over to those cheaper products. But if the rates do increase, at least it means you have a rate locked in to protect you against any of those further rate increases. The mortgage market should be viewed like any other kind of market. Let's say stocks and shares, crypto, whatever it is that you may invest in. If we see a downtrend or an upwards trend, there will be peaks and troughs within that. So instead of trying to time the market, like I said, just lock into the best rate possible and then utilize that rate check service moving forwards. And just moving on to the next slide, please. So just a few things to consider for the process. Now, we come across a lot of first-time buyers who do some questionable things before obtaining a mortgage. So, please try to avoid the following. Try not to take out any financial burdens before completion of the mortgage. I've seen too many times now where this has affected affordability and the process itself. As well as that, make sure that you have the correct documents linked to your current residential address. Now, we see this a lot with work professionals, students who kind of bounce from one address to another. Regardless of where your documents are registered, let's say, for example, they are at your parents' house, but you live elsewhere, we wouldn't be able to use your parents' address for EIDs, which is electronic identification. So on that basis, just make sure that all documents are registered to where you currently live. extra brownie points if you're on the electoral roll, that can be good for credit scoring. I'll touch on that in a moment. Now, I would also say not to neglect your credit file. It is one of the most important assets that you'll have when being a first-time buyer. It demonstrates, who you are to the lender and whether or not you're fit enough to take out a large debt from their perspective. Now, most first-time buyers do not have a sufficient credit footprint. So to ensure, the lender deems you as reliable, consider building credit via credit cards, signing up to the electoral roll, like I've just said, and making sure that there's no marks that may hinder your opportunity to get a mortgage on the credit file, such as any CCJs, missed payments, defaults. And lastly, things to just consider, having the correct kind of documentation in place. So let's say if you are, you are employed and you get paid monthly, I would suggest to have 3 months pay slips at hand, 13 weeks if you are paid weekly. Sorry, I should say 13 pay slips if you are paid weekly. And if you are self-employed, have at least 2 years of self-assessments. Certain lenders on the market are happy with one, but generally, rule of thumb, it's 2 years. And lastly, 3 months bank statements. And then just moving on to the length of process. So 3 months is generally the standard. However, I have seen the process stretch across 6, even 9 months. There are a lot of variables to consider. For example, if you were part of a chain, that could lengthen the process. Now, you can't control all variables that would be involved. So what I would advise you to do is just be as prompt as possible during your process. So anything that the mortgage advisor would want, anything that the lender may request, anything that the conveyancer may request as well, just be as prompt as possible to answering all those questions and queries. So yeah, that is the process in a nutshell. I know I say in a nutshell, I've just kind of chewed your ear off for a few moments there, but it can be stressful. But remember what you are doing it for. There's no better feeling than getting the keys to your first home. But yeah, Siobhan, I'll pass it back over to you.
Brilliant, thank you. I think it's back to Joe, actually. So back to you, Joe.
All good. That was an amazing overview. Thanks so much, Ismail. Right, we know there's been so much to digest today, lots of information. Hopefully you've been able to take away some sort of key tips to consider when buying your first home. I suppose that brings us on to the final takeaways before we start answering some of your questions.
Oh, so I think takeaway number 1 is consider using a mortgage broker who has access to multiple lenders to give you a holistic view of what's available and how much you can borrow. Secondly, the mortgage process, as Ismail mentioned, can be overwhelming, but make sure you ask your advisor as many questions as possible to be able to support you.
Get all of your documents together. Make sure you've got everything together in advance if possible. It might save you a whole lot of time in the process. And there's no real wrong time to buy. The right time when you found something that is right for you, and the key thing is affordable as well. Great. So before we jump onto the Q&A, just a very quick one. If you did want to inquire about a mortgage with L&C, we've got a QR code here that you can scan, which will take you through to our online inquiry form. So feel free, everybody, to scan that now and start filling in all your details. And we've got about 13 minutes and plenty of questions to answer now. So we're going to start rattling through these quite quickly. If we don't get the chance to answer all of them now, we'll make sure we add them onto the end of the recording of the webinar when it goes up onto our YouTube in a few days' time. So we'll make sure you can come back and see all of your questions answered. So let's start at the beginning, I guess. What would be the right purchase price band for first-time buyer to get the better benefits now and in the future? Dave, I think that one's for you.
I'll have a go. That's a really difficult one. One thing I would say, you can see that there's massive regional variation. So to say what the right price band is going to vary substantially from one region to the next. But look, you've got to just gauge it on what's going to be affordable for you and whether it's getting you the kind of property that's going to meet your needs, I think. I know that sounds perhaps a bit airy-fairy as an answer, but the bigger the deposit you have in terms of benefits, I think you've got to look at the benefits of a home, not just as an investment. So perhaps look at it more as how is this going to work for you, rather than looking at it as an investment. If you've got a bigger deposit, that will get you better rates. So whilst we've talked a lot about 5% is the typical minimum, although there are some that can offer less. Actually, if you can get 10%, then you'll get a slightly better rate on offer. If you can get to 15%, you might get better rates again. All the time, you're building up some more equity there, so it gives you more opportunity. One of the things that you can do to try and build that deposit, the lifetime ISA is something that's worth looking at if you're just in the process of building that deposit. There's a government bonus that is added to your savings, so it can help you keep pace with prices if you feel that they're just edging ever higher.
Perfect. Thanks, Dave. Got one for Paddy here. What is classed as a new build? To be specific, how many years since the property was built or was ready to live in?
Thanks, Siobhan. Yeah, it's a great question. Generally speaking, and lenders will have slightly different approaches, but generally speaking, a new build is classified by most lenders as first occupancy within 2 years of practical completion, or since the property was ready to be lived in. I've done a fair share of time at a few lenders, and that's generally the rule of thumb. I think there was another question about on the subject of new build about particular schemes, and they're very developer specific. So would be worth, if you found a particular property on a site that you like, it's probably worth having a chat with the developer or the sales agent there to see what schemes are available, if any, for that particular site as well. Hopefully that answers both those questions.
On that one, Paddy, the 2 years, it is probably worth people understanding that actually new build can relate to those that are newly converted or refurbished as well, which is obviously something that perhaps you wouldn't necessarily always expect. It's not always has to be a brand new property from the start.
Yeah, totally agree. We've seen more and more developers taking a bit of shift in their focus, where they're actually, for example, renovating commercial premises to residential property, and the same sort of rules apply there, where it's sort of 2 years, generally speaking, within or first occupancy within 2 years rather. So yeah, great point, Dave.
Excellent. Ismail, one for you here. Who is liable to cover the mortgage in the event of death, presumably of the mortgage holder?
Yeah, so I'll try and answer this as best as possible. I mean, I don't necessarily work with protection, but again, it's the person that would be liable to pay for, if it was a joint application, you're both joint liable to pay for that mortgage. So if one was to unfortunately pass away, the responsibility would fall on the next of kin, which would be, the next person on the title deed of the mortgage. In regards to it being a solo applicant, if you were to pass away, Dave, what would happen with that? I'm sure you know the answer to that better than I would.
Well, I guess the estate would be liable.
Yeah.
And then, of course, you'd be looking to probably sell that property, would be then used to repay the mortgage.
Yeah. So in a nutshell, yeah, that's the answer.
That's where protection is important to consider. How are you going to pay the mortgage? Not only in the event of something terrible like death, but also if you're not well enough to work, for example, so income dries up. That's where it can be a real help for first-time buyers as well as more established homeowners.
Perfect. Thanks, Dave. And Ismail, another one for you, Ismail. So when making an offer on a property, what information has to be provided to the estate agent?
Yeah, so good question. Like I touched on beforehand, so this is why it's good to speak to a broker before you do place any offers down. What you would want to see is your decision in principle certificate. So that would kind of demonstrate the affordability that the property that you are looking to place an offer down is financially feasible. They will then ask for solicitor details as well. so they can then exchange that with the seller. And they will also ask for proof of funds. They'd want to see, that you do have the deposit there waiting, so that you can kind of prove to the seller that you are a serious buyer in that sense.
Perfect, thank you.
Excellent. Dave, one here for you. What tends to be the best mortgage, fixed rate or variable?
Yeah, that's a good but very often asked question. Seems straightforward. Fixed rates do what they say on the tin. They're not going to shift over a particular period. You can fix anything really from 2 years right through to the life of the loan now in some cases. But longer term fixed rates have become more widely available. So you can tailor that to what works for you. That's going to suit people who just want to know where they stand. They don't want to be worrying about what happens with base rate. We've got a meeting this week. Is it going to go down, stay the same? What's going to come from that? Fixed rate will just mean that you know exactly where you stand. Variable could work out better. So to say what's best depends on what you would define as best. Everything's easy with hindsight. You just got to look at, yes, it could go down further if base rate were to fall. So a base rate tracker is directly pegged to base rate. It could reduce if base rate continues in the downward direction. But of course, you've got to think about how would you cope if that doesn't quite pan out that way. As much as it might be expected now, we don't know what's around the corner. So if it were to rise, that would put upward pressure on your monthly payments. How much leeway have you got? And actually, I just say, look at an online calculator, play around with some scenarios, and how comfortable might you feel if interest rates went up by 0.5%, something like that. If that starts to look pretty tight, then you might want to head towards the comfort and safety blanket of a fixed rate.
Perfect. Thanks for that, Dave. Hopefully that's answered that question. Another couple here for Ismail. So first one, is there a maximum age limit for a first-time buyer? I'm 46. Can I take a mortgage as a first-time buyer? And then secondly, will the house buying process be the same with a new build, e.g. having a house survey being done?
Yeah, so two very good questions. In regards to the first question, there's no like set age limit apart from, so with certain lenders, for example, the max age would be up to 75. It can stretch to 80 in some cases. So if you were 46, what we'd be looking at is having a mortgage term that fits within, your age and then the max age that the lender was able to offer. In regards to the second question, the process doesn't really differ too much. We will kind of pull out more information from you regarding the new build. So, who the developer is, whether or not there's any kind of building incentives that you'd be putting towards the deposit. It can sometimes be a little bit more lengthy. Certain lenders will have to wait until the house is built before they can go ahead and complete a valuation. However, a lot of lenders have adjusted to this and will provide desktop valuations, which again would mean that you get the mortgage offer at a quicker rate than you would previously. So yeah, not really much of a difference between the first time buyer process for buying a traditional property and a new build.
Right. Paddy, one for you here. How does one find out if a particular property supports a given buying scheme? So this one, thinking the new build one specifically. How do you link those things together?
Thanks, Joe. Yes, good question. So some of these schemes are only really just starting to emerge. Some of them have been in pilot for maybe 6 months, and that's probably the earliest one that I can think of. But they are becoming more and more available. As a result of that, I suppose it does mean that they're not available via every developer nor every mortgage lender. So I would always, if you are particularly interested in buying a new build and sort of seeing what schemes or incentives are available, I'd always have that discussion with the developer themselves when you go to view the property or in your appointment with them. and they can sort of say actually what incentives and what schemes are available. So that will be at the moment driven by the developers rather than anybody else. But it's hoped that it will become more widely available as we move into the next calendar year.
Perfect. Thanks for that, Paddy. One here for Dave. What would be the right purchase price band for first-time buyer to get the benefits now and future?
I think we covered that one.
Have we done that one?
Yeah.
Perfect. We'll go on to another one then. Okay, let's go down. There's quite a few that's come through. So how does a leasehold work versus freehold?
Yeah, so leasehold will commonly be found, if you're buying a flat, it doesn't have to be a flat necessarily. There have been leasehold issues with houses. But typically, if you're buying a flat, especially, it's going to be likely to be leasehold. In terms of, how does that affect the process? There will be a little bit more to go at in the legal side of things. So the conveyancer will want to dig into what the terms of that lease are. From a mortgage perspective, one of the crucial things for you to understand will be how long is left to run on the lease. Now, lenders will not like a shortening leasehold term remaining, so they'll typically have minimum requirements on that. But also for you as a buyer, you want to understand what's left remaining on the lease. The other thing that you would want to understand would be what kind of service charges might be in play, and then your conveyancer will help you understand what is in place in terms of a potential fund to cover any repairs, whether there's anything coming up. So that's to protect you against unforeseen expenditure. So those are the kind of things, understanding how things work in a practical sense. But in terms of the actual process, it's largely the same, but probably more legal work and probably a bit more cost on the legal work as a result.
Perfect. Thanks for that, Dave. I think we've hit 6:30, Joe.
We are out of time. Thank you so much, everyone, for attending the webinar today and all the fantastic questions. As suspected, there are a whole bunch more in there than we've had the time to answer. So what we will do, as I mentioned, we'll do our best to tack them onto the end of the video when we upload it onto YouTube and our social medias. We'll send out the link to that in the coming days. So hopefully you won't have too long to wait to get the answers to your questions, because there's loads more great ones in there. I guess all that's left to do, thank you everybody for attending. Thank you for coming. Thanks to our fantastic panel, Siobhan, Paddy, Ismail, Dave. It's been great, and hopefully you've all found it really, really useful and have a bit more information and a bit more confidence to get out there and find your dream homes. So yeah, I think that's everything. Thanks so much. Have a good evening.
Thanks, everyone.
Thanks all. Cheers.
Thanks. Take care. Thanks.
Hi, everybody. As mentioned on the webinar, we had so many questions, more in fact than we can get to in the time we had available to us. So, as promised, I'm going to have a quick run through all the other questions that were asked and provide a few answers here for you. Relaxing affordability or lending more on salary, are these good ideas? Or does it make it difficult for buyers to cover bills every month once they have the property? Great question. So lenders are working hard to offer more flexibility in the amount they can lend and are particularly focused on first-time buyers, although there can be some eligibility requirements, for example, minimum income levels. Now this could be £30,000 for a single applicant or £50,000 for joint applicants, but it might vary by lender. However, just because a lender could offer a maximum amount does not mean that the borrower should necessarily push to the max. It's important to feel comfortable with the level of monthly payment that you take on. When making an offer on a property, what information has to be provided to the estate agent? In theory, you simply need to say how much you want to pay for the property to make an offer. An estate agent is likely to want to understand that it's plausible, but you don't need to use the agent's advisor. Speak to a mortgage advisor if you'd like to get a mortgage in principle, but these don't guarantee the mortgage. They can be helpful in demonstrating that your offer is serious. House prices shot up with COVID. What will bring house prices back down? This stems back to the supply and demand issue that we discussed in the webinar that has seen prices rise over the years. Now, the government has set some challenging targets to build more homes. If the supply of property increases in line with demand, it should help to steady the rise in prices. If wages continue to grow as well, then affordability should improve. If a property is on the market from May, what is the lowest we can offer? Also, as Zoopla and other websites provide a ballpark figure, how accurate are these property estimates? So you can offer what you like on a house, but of course the vendor can choose whether they think it's reasonable or not. Keeping an eye on the local market can help you understand what properties are moving and at which price they're going for. This should help you gauge whether the asking price is too high, too low, or just about right. That variation is critical. As you say, websites can give you an overall picture, especially if there are recent sales of similar properties in the area, but these are best judged as an indicator. I did a decision in principle from L&C last month and received an email stating the value that I would likely be offered, although I am unsure of the next steps. Do I start to look at properties based off this figure? My concern is that when I find a house and go through the mortgage application, I wouldn't necessarily be offered the same amount and therefore be unable to buy the house. The decision in principle is an indicator of what you may be able to borrow. To get a better picture of whether that level of borrowing could be appropriate and likely, it makes sense to have a discussion with a mortgage advisor to help you better understand. Now, they could get a credit checked agreement in principle from the lender, although that still won't guarantee the mortgage. It will give you more comfort if you're worried about qualifying. That should help you get a better idea of properties that could be in your search. Do you think you could help to recommend an estate agent who can help to find a property, keeping in view the constraints of first-time buyers? So remember that an estate agent works for the seller of the property rather than the buyer. Property portals can give you good access to searches of the locality you're looking at, but it could also make sense to go and talk to some local agents to understand what's on the market and put you on their list for new properties coming to market. For proof of deposit, is it necessary for the money to be in my bank account, or can other sources like money in the stock market be used as proof? So conveyancers accept deposits through their corporate account, and as they're handling funds, they need to know it's come from a legitimate source. So I'd certainly recommend having documentation available to show the source of funds for conveyors. The broker will also need to ensure that the source of that deposit is acceptable as per the lender's criteria. What did you mean by self-assessments? This is simply referring to tax self-assessments for self-employed borrowers. Lenders will typically use 2 years track record to verify their income levels. How do fixed rates protect banks against negative equity? So fixed rates give borrowers more surety that the mortgage payments will remain affordable even if the rates alter. You can't affect what happens to prices, but if the mortgage remains affordable, then there's less need to sell the property, which would crystallise any loss due to negative equity. So it can help the borrower, not the bank, to ride out any drop in prices. If you have a large deposit, 20 to 25%, does this reduce the interest rate, and if so, roughly by how much? Does it scale, or is there a cap? So the larger deposit, the better the rates are likely to be. The lowest rates in the market are typically on offer to those with 40% to put down. Now, a 25% deposit won't be too far behind, but every 5% can make a difference to the loan to value banding. So if you're at 86% of the purchase price or a 14% deposit, you might want to consider whether you can stretch the 15% deposit, which could open up a lower rate. As a mortgage applicant in a sales profession who receives a base salary with additional commissions and bonuses, how does this impact affordability or underwriting? Where income is variable, lenders will often want to see some track record, but many will be able to factor in regular commission and bonus income where there's evidence. Some might only take a proportion of the variable income into the affordability calculation, but taking advice should help you get the best fit. Can you remortgage each time a fixed term comes to an end? And is there a maximum amount you can do this? So yes, you can, and you should make sure that you're reviewing your deal about 6 months before it comes to an end. Advice will help you compare rates from right across the market with any deal that your existing lender might offer. Can I get a joint mortgage with someone on universal credit and with a part-time job, or does it need to be a full-time job? Now, there are lenders that are happy to accept universal credit or benefit income, provided that it's guaranteed and it will be in place following completion of the mortgage and throughout the mortgage term. It's best to check with the lenders. Would you stress the importance of speaking to an advisor before viewing houses, even if you had already completed an online mortgage in principle? So it makes sense to have a discussion with an advisor, especially if you're concerned about issues that could affect whether you'll be able to qualify for the mortgage. A mortgage in principle can be a useful indicator, but doesn't guarantee the mortgage, even if it's been credit checked or scored by a lender. So speaking to an advisor may help to unearth any issues to consider and hopefully give you some reassurance. Do I have to have made an offer on a house to be able to find out exactly which mortgages I'm eligible for? So you can certainly take a look at what's on the market and get a good idea of what you might be able to get. However, you can't make a full application until you've found a property, as the lender will need to assess and value the property as part of the process. If you have your own limited company, so a company director for instance, have account for the last 10 plus years, but currently no income coming in as you're between contracts, but you still receive a salary from that company, can you still get a mortgage if the accounts are good for the last few years? Now, there's an awful lot of variables in this question, so probably the best thing to do in an instance like this or something similar would be to speak to an advisor. And those are the questions. Thanks again for everybody that tuned into the webinar, and thank you to all of you who are watching this on YouTube. Keep an eye on our socials or in your emails for any future L&C webinars.